Your portfolio just dropped 30%. What do you do? If that question makes your stomach drop, you're not alone, and this video is going to change how you think about what happens to stocks in a crash. When stock market volatility hits, the instinct is to sell, protect what you have, and wait for things to calm down. But here's what the data actually shows. That instinct is one of the most expensive mistakes a long-term investor can make. Let's look at history for a real market crash investing strategy. During the 2008 financial crisis, the S&P 500 fell roughly 57% from peak to trough, devastating on paper. But investors who stayed the course saw the market fully recover within a few years, then go on to reach record highs. In early 2020, markets crashed nearly 34% in a matter of weeks, then recovered to all-time highs within months. The pattern repeats. Crashes happen, recoveries follow, and long-term investors who hold through the storm consistently come out ahead. So what actually happens to a diversified index fund portfolio during a crash? Your account balance drops, sometimes significantly, but your underlying assets, the shares you own, remain intact. You haven't truly lost anything until you sell. As Warren Buffett has said, the stock market is a device for transferring money from the impatient to the patient. This is where investing psychology becomes the real battleground. Watching your portfolio fall triggers the same fear response as a physical threat. Your brain wants you to act. But a sound bear market strategy for long-term investors is often about deliberate inaction. Peter Lynch, one of history's most successful fund managers, noted that far more money has been lost by investors preparing for corrections than in the corrections themselves. So should you sell stocks in a crash? For most long-term investors, the answer is no. Here's a practical framework instead. First, check your asset allocation. Make sure your portfolio matches your actual risk tolerance and time horizon. Second, keep investing if you can. Buying during a downturn means acquiring shares at a discount, accelerating the power of compound interest over time. Third, do nothing else. Index fund investing works precisely because it removes emotion from the equation. You own a slice of the entire market, and historically, the entire market has trended upward over long periods. As we look ahead, volatility will come again. It always does. But the investors who build real wealth aren't the ones who time the market perfectly. They're the ones who stay in it long enough for compound interest to do its work. Set your strategy, diversify, and let time be your most powerful asset. If this breakdown was useful, hit subscribe for more straightforward investing content and share it with someone who needs to hear it before the next downturn.